Thank you.
Well, thank you, everybody. Something slightly different, change of pace, with a lot of commonality to what's already been said. So we're going to talk today about the standard problem that we all face most of the time. There's always something to worry about when you're investing your own money and other people's money, but particularly at the moment there's some interesting things that are quite challenging. We've been through this period where monetary policy has been extraordinarily stimulatory. Some frankly bizarre things have happened that 10 years ago you just wouldn't have believed, in terms of central banks buying assets off the private markets and the secondary markets, pushing down interest rates. The whole thing here has been to make cash as unattractive as possible and to get people to go out and invest in risky assets. And of course that's bid up valuations absolutely everywhere. This rising tide sort of has floated all boats. So obviously when valuations are fairly stretched, in the long term that's suggesting that returns are going to be fairly unexciting going forward. So what can you do about that? We don't have a crystal ball. We're not saying that the market's about to crash tomorrow, the next day, or the next 5 years. But what you can say is sometime in the next 10 years returns are going to be pretty disappointing from bond markets and from equity markets. So what can you do about that? Hopefully funds like ours, we're definitely what you call a hedge fund. In particular, we're a global macro hedge fund. But funds like ours are just trying to offer an alternative to your standard assets, your equities, your bonds, your real estate and things like that. Not a substitute, just something that you can use to diversify some of that risk going forward. This bull market, I don't need to tell any of you guys, it has actually been going for a very long time. In the US, it's now the second longest continuous bull market in history. This chart here has the returns of the ASX 200. You can see it here, we like to put things on a log scale when we're looking at return indexes, so that a similar size fall at any point in that time series represents the same percentage loss. So if you fall that much there or that much up there, they're both around 50% fall. So that's something we're going to do all the way through this presentation. You can see the grey areas are the US recessions. So this is the tech wreck. Australia was pretty immune, but returns were pretty ordinary for a while. And obviously that was the GFC. The economy here got out of that fairly lightly, but the stock market got belted. So so since then this thing's been growing for about 9 years, and that suggests perhaps that it's getting time to think about an alternative. Might be prudent. One of the things for the last 25 years that's been a very good way to diversify equity risk has been bond markets. Pretty standard sort of safe haven asset. But the thing, let me go back. The thing that's happened here with bond markets is the returns have actually been in Australia very similar to what you can get in the stock market for the last 25, 30 years. But there's been this one-off, once-in-a-lifetime, sorry, I will stop doing that soon, once-in-a-lifetime reduction in bond yields. This is common all around the developed world. And so you can't really expect that to continue forever. Obviously, interest rates quite novelly have gone through zero in places, but that's at the short end. And so you cannot expect the phenomenal returns that we've seen for the last 25, 30 years from bonds going forward. So it makes this challenge of finding out how to diversify your equity type risk, even harder than usual. Just sort of highlight quickly as well that in this period, every time there's been a crisis, yields have rallied. Yields have fallen, which means that bonds have outperformed very strongly. So they've had this safe haven type characteristic. But that's a fairly recent development, sort of started around 2000. Look back in 1994, those of you who were in the markets around that time, you'll remember that bonds and equities can sell off at the same time. If interest rates and or inflation are the problem that people are worried about, that bonds don't represent a place to hide in a crisis. So just some basics of the mathematics of large drawdowns in risky assets. this is like a drawdown chart, so it's picking the difference between the previous high on this chart, so that point there, down to there, it will not get back to zero again until you take out your previous high in terms of the cumulative returns for these indexes. So this is the drawdown that's associated with the global financial crisis. So the point here is that if something falls by 50%, it's not a matter of then earning 50% back to get where you were. That only gets you back to 75% of the money you had at the beginning of the drawdown. The point here, so you really want to avoid drawdowns because of the way compounding works, basically. You've got to work a lot harder to get back once you've lost that capital. And the bigger the drawdown, the worse it is. Sort of point reminds me of an old joke that an ex-colleague used to say. So, what do you call an asset that's gone down by 90% and then it halves again? That's something that's gone down by 95%. Which when you think about it, it's pretty amazing. So, where can you diversify? I'm not trying to scare the pants off everybody, but I just think it's prudent to think about it at this point when things have been going quite well for a long time. So some people, as I said, look to bonds, but we are cautioning that they just can't keep outperforming the way they have. It's been extraordinary, the performance of bonds over the years. Here we have a set of time series that go up to when the global financial crisis was getting very serious, in halfway through 2008. You can see global equities are already starting to roll over at this point, haven't taken out a new high for almost a year. Sounds a little bit familiar. And you've got some places to diversify. So bonds, which have been going well recently, but again, might not continue to do so. FX here, basically this is being long everything against the US dollar. So you're long the Aussie dollar, you're long the yen, you're long euros, you're long pounds. It's a place where some people like to diversify. And then back in the noughties, it was very, very fashionable for people to buy baskets of commodity futures. So AIG and Goldman Sachs went around the world convincing people that this was a clever thing to do. You get equity-like returns with negative correlation to equity markets. So it was a great diversifier. Of course, what happened to these so-called diversifiers, equities continued to crash really quite violently, but commodities disappointed as well. So it is actually, there are some good reasons why that happened. Those markets were crowded. That whole idea of diversifying your equity risk using commodity futures was never a very deep strategy, and Goldman's and AIG basically encouraged too many people to get into it. But that's how it ended, pretty much in tears. And you can see currencies didn't offer great diversification either. And bonds actually did hang in there reasonably well, but again, probably not going to happen next time. So what can you do about it? How do you actually achieve diversification? We often hear people talking and they say diversification's great in general, but it deserts you in a crisis. And we tend to disagree with that a little bit. So what we prefer to say is, well, the maths of diversification always works. They never stop working. It's just that your actual correlations have changed, and you've got to really focus on how to measure these correlations. So just to try and to show exactly what we mean about how quickly these things can change and what it means for a portfolio, we've got our this is the way we measure correlations within our space. So we've got 18 world equity markets there, and you can see the dark green colour on this heat map signifies that they're very strongly positively correlated with each other. Below that, we've got a collection of fixed income markets. These are 10-year bond returns around the world, and you can see they're positively correlated with each other. And back in July 2008, as the crisis was brewing, you can see they offered quite a lot of diversification to equities. So a red colour is a strong negative correlation. You could be long bonds, long equities, and that was diversifying you at that point. The currencies here are G10 against the US dollar, so 9 global developed market currencies, and most of them were diversifying. You can see the two really dark red ones there, Japanese yen defensive, Swiss franc defensive. Things like the Australian dollar and the New Zealand dollar, less so. They're risky currencies, always have been. But also, interestingly, the commodities a lot of those had a negative correlation with equity markets as well. So you could buy these things and achieve some diversification going into the crisis. If you buy and hold those ideas, this is diversifying. Historically, recently, it has been diversifying. But then you buy them hoping that continues. This is our point, is that can be extremely risky. So jump forward 3 months. It's exactly the same matrix, but just updated through time. You can see what's happened to the correlations the way we measure it. All this lovely correlation structure in here, it's all switched to either being green or red. Bonds extremely defensive after the crisis. So this is immediately after Lehman Brothers has collapsed, and the full-scale GFC panics really kicked off. You can see the Japanese yen there, extremely defensive asset. All the investors in Japan been funding a lot of the stuff around the rest of the world. They wanted their money back, and they were demanding it back. Swiss franc starting to become defensive, and then you've got the VIX right down the bottom, which I didn't introduce earlier, but it's a very defensive asset. And you can see here that the commodities have just suddenly become green. So basically, all the commodities were behaving like equities all of a sudden. So when you bought these guys hoping that the commodities would give you diversification, that's what happened. You basically just had a double exposure to equities and got burnt by it. So where are we at? It's getting late in the cycle. It's very long expansion. Equities and bonds are expensive. Now, that doesn't mean we're going to have a crash tomorrow, but it does mean over the next 7 to 10 years that returns are going to be disappointing for those standard assets. Drawdowns hurt. You really want to try and avoid drawdowns all the time because it's so hard to make that capital back once you've lost it. And traditional diversifiers, when you're in the middle of a crisis, can become very much like risky assets and therefore desert you if you're not sort of keeping track of these changes that we've just shown. So how does a fund like a global macro fund actually try and help this? So in our case, we're trying to offer equity-like returns, so 8% over cash. That's actually probably higher than you'll expect to earn in equity markets over the long term, with a volatility that's around 10% per annum. So that's actually less than equities, which in the long run is probably 16 to 18%, but still pretty punchy. It's a risky type asset. It is a bit of a bumpy road sometimes. And what we're really trying to do here is to add these returns without a correlation to bond, equity markets, commodities, or just about anything else passive that you can mention. So this is why we think they might help in a crisis. How do we do this? Sounds miraculous. Well, there's a couple of things that we do. Like one is we focus on really liquid global markets where we can change our exposure very quickly. Very cheaply, very quickly. We can go from completely long to completely short in a matter of days, and we won't disrupt any markets and we won't have much in the way of transaction costs. So we've got the freedom to completely change the exposure very quickly and very dynamically. We trade a lot of different markets that behave very differently, and we trade a lot of spread trades between those markets. So at the moment we trade 54 different markets. That's pretty typical for us and our competitors. But you can, by having, one dimension of it is you can say I like equity markets or I don't. But then within those equity markets, there's 18 different spread trades you can do just against those. And then you can trade a basket of equity markets against a basket of commodities, for example. So in this space of 54 markets, there are just so many different dimensions that you can take risks that you can basically try and find something that works. The goal is to try and find something that works all the time, but in those different positions by taking so many well-diversified positions. Here's an example of what our simulated process would have done during the GFC, just to show you exactly what I mean. So this is just focusing on net asset class positions. Again, heaps of spread trades within these asset classes, but if you add up all the exposure to equities, you get that green bar there, green position through time. So going into 2007, we were quite long equities by our standards. As things rolled over, we got ourselves short. The orange guy is fixed income, so we was flirting with being short there as well. short commodities the whole time, but you can see that changes around. And so being long FX here is being short the US dollar. So we were going short the US dollar going into it. You can see as the crisis erupts properly, the end of 2008, the positions get a lot smaller. That's just being careful about risk control, doing some clever position sizing there. But you can see as equities got cheap, we started to think about getting long. The crisis got worse, sort of changed our minds. But then as yield curves steepened, central banks reacted, tried to help the situation around the world. We got ourselves really quite long fixed income, and of course bonds and equities had such a strong negative correlation that encourages you to also go out and buy equities, which were now cheap as well. So coming out of the crisis, you get long equities, long bonds, stay short commodities. But hopefully this shows you that it is quite dynamic. We are reassessing it all the time, and you're taking the freedom of trading these markets that are deep and liquid in futures markets to adjust your exposure very rapidly when you need to. So how does this work in terms of a standard sort of portfolio? We're not saying run out and buy 100% of two trees or anything like that, but we are saying that this offers some serious diversification to a standard set of assets. So a bit of a straw man here. You've got your 60-40 portfolio. There's the Australian ASX 200 cumulative returns. Let's pop in 40% exposure to Australian bonds. You can see it's, let's go back. You can see some of the drawdowns are getting smaller, returns are flatter. That's a better outcome. But what happens if you take 10% off each of those guys and put that into a hedge fund like a global macro hedge fund like Two Trees? You can see completely irons out that drawdown, which is very nice. Smaller drawdowns here as well, and hopefully you can tell that that's a better outcome in terms of a Sharpe ratio. So again, smaller drawdowns, better compounding, better ultimate capital at the end of the game. So, won't go through that again. Just to summarise, basically, my point is that it's better to think about these things now and consider something that is trying to be truly diversifying when things are going really well, rather than sort of wishing that you had have done something that was diversifying after your standard assets have all crashed. So we're not saying this is going to happen next week, next month. We don't have a crystal ball. It's just it's very good to think about it before the event rather than after. With that, I might wrap up.